Welcome to today's deep dive, customized just for you. We are looking at a really fascinating source today on Forex trading.
Yes, specifically looking at the hidden costs of those low spread brokers.
Right. Because a two-pip difference on a chart, it looks completely microscopic.
Oh, absolutely. It looks like literally nothing.
But for an active trader, it's basically this tiny silent leak in the hull of a boat.
Yeah.
It doesn't look super dramatic, but over time, it absolutely sinks you.
Yeah, that is a great way to put it.
So our mission today is to figure out why this seemingly tiny difference can be the deciding factor between a trading strategy that actually scales and one that slowly bleeds your money.
Right, because when you see a broker heavily advertising, a point zero minimum spread, experienced traders know they're usually just looking at top-of-book pricing.
Okay.
It almost never reflects reality. We really have to look at the mechanical friction sitting right behind that headline number.
Wait, I have to challenge that right away. If a broker legally guarantees a raw spread of zero point 0.0, isn't that just mathematically better for my bottom line?
Well, that guarantee only really exists in a vacuum.
How so?
Like during peak liquid hours, sure, the gap might actually be zero. But look at the mechanics during a major news event. The big Tier 1 liquidity providers, they pull their orders from the book.
To protect themselves from volatility, right?
Exactly. So the broker isn't maliciously widening the spread. The actual underlying liquidity pool has just dried up.
Ah, I see.
Yeah, so your market order gets filled at whatever price level is left further down the order book, which introduces massive slippage.
So seeing a zero pip spread is, it's a bit like seeing a free shipping sign, only to find out at checkout there's a massive handling fee.
That is the exact mechanism, yes. You might have clicked buy at 0.0, but the delay means your order gets filled, say, 1.5 pips away.
Wow.
Add in a separate round-turn commission, and that quote-unquote free trade just cost you a lot.
But I'm guessing that, that latency tax hits different trading strategies unevenly.
Oh, totally. Because that free shipping isn't really free, how much it hurts your wallet depends entirely on how often you trade.
Right, so a swing trader holding a position for like 3 weeks probably doesn't care about a 1-pip slip on their entry.
Exactly. For a swing trader, server stability outweighs microscopic pricing. But for scalpers or intraday or algorithmic traders making frequent moves,
The ones running those high-frequency models.
yeah, for them, tight pricing is literal survival. And this is where account structure comes in. With spread-only accounts, the broker basically bakes their profit directly into a slightly wider quote.
Which gives you a simpler, predictable cost per trade, but you sacrifice the raw market pricing.
That is precisely the trade-off. It's simpler for beginners. But on the flip side, you have commission-based raw spread accounts.
Okay, and those give you the raw point 0 pricing.
Right, but you pay a fixed commission per lot.
So it's like choosing between a flat rate buffet or paying per plate. Which one is better depends entirely on how many times you plan to go up for food. Right.
Yes, exactly. To know if you're actually saving money, you have to calculate the full all-in cost.
Yeah.
Entry slippage, exit slippage, and the commission. Combined. All of it.
Which means just comparing minimum spreads on some broker review site is completely useless.
You're just comparing best-case marketing fantasies at that point.
So how do you measure reality?
You have to track the average spread, specifically looking at the London and New York overlaps. That's when volume is highest.
Okay, that makes sense.
But again, a tight average quote means absolutely nothing if your order routing is sluggish.
Because, like the source points out, if my order is delayed and gets filled at a worse price, the spread advantage instantly vanishes. So in this world, speed literally is price.
It really is. And the platform choices matter here too, like MT4, MT5, cTrader. It isn't just about the charting interface.
It's about how the platform handles order routing.
Exactly. cTrader, for example, often utilizes different API connections than older MT4 setups, which can physically shave crucial milliseconds off that latency.
And that's why finding a unified ecosystem becomes a strategic advantage, right? The source mentions Monaxa as an example.
Yeah, if you're trading Forex, but also want exposure to metals, indices, or crypto, you need institutional-grade routing across all those assets under one roof.
Otherwise, you're fighting different execution speeds across fragmented parts of your portfolio.
Right. Consolidating into a broader ecosystem means you aren't just saving pips, you're gaining absolute control over your capital.
So to summarize our takeaway today, the right broker isn't just the smallest number slapped on a comparison table.
No, not at all. It's the optimal combination of competitive spreads, clear pricing, and ultra-low latency execution.
You really have to look past the marketing.
You do. You have to stress test the actual trading environment.
Which leaves you with this final provocative thought to mull over today. If a broker's entire marketing strategy relies on screaming about one flashy zero-pip minimum number, what hidden systemic costs might they be deliberately trying to distract you from? Keep an eye out for those tiny leaks because you definitely want to keep that boat afloat.